The following marketing information and discussion is provided for informational purposes only. It is not intended to be used as professional guidance or consultancy. You should find an agency for that. Comexis is a digital marketing agency, so feel free to hire us. But otherwise, just enjoy the show.
Hello everyone, welcome to The Buyer's Journey by Comexis, a discussion-based podcast on the ever-changing marketing landscape. I'm Matthew McGroarty, the social media content producer here at Comexis.
I'm Len Ward, the managing partner at Comexis.
And I'm Josh Lyons, the digital marketing coordinator here at Comexis.
So on Mondays, we normally talk about the awareness stage of the buyer's journey, but all last week, we decided to talk about earnings reports for platforms and companies that are important to the digital marketing landscape, and we are finishing up that series of episodes with today's focus on Microsoft's earnings report, which obviously we're looking for LinkedIn information on there, and then we're also going to be talking about Spotify's earning report. So we're going to start with Microsoft because Microsoft is the most straightforward, and there's not a whole lot of LinkedIn information in there, so get this off pretty quick. So Microsoft reported its earnings for its third fiscal quarter. They do third fiscal quarter around this time, so anytime I mention comparisons to the third quarter of 2018, that's why. It's because technically most people do quarter one. Anyway, they had a revenue of $30.6 billion, a net income of $8.8 billion, and an earnings per share of $1.14, which is big bumps compared to the last year where it was $26.8 billion in revenue, a net income of $7.4, and an earnings per share of 0.95 cents, not 0.95 cents, 95 cents. Expectations were for $29.8 billion in revenue and a per share of $1. So they beat those expectations pretty solidly. And LinkedIn revenue had jumped a solid 27%. Obviously, we know and we've talked about a lot of the different things that LinkedIn has been doing in the past months to sort of foster more engagement on the platform. I think that's obviously one big way in which they can increase ad share and promoted posts on LinkedIn by making it so people are more likely to engage and stay on time on site, et cetera, et cetera. So just very quickly, what do we think about that? I mean, there's not a lot in there other than LinkedIn jumped up, but.
All right, so for the earnings reports, what we're looking for when we're discussing the earnings reports of all these platforms, I think as we do these podcasts, they'll get a little, cleaner for people to understand, less ranting and more, actual, takeaways. The takeaway you have to think with LinkedIn here is when we look at earnings reports from a digital marketing perspective, we're trying to look for growth in ad revenue, we're trying to look for growth on their marketing vehicles, where we then would say, okay, that's good. That's the first thing we're looking for. But the second thing is sustainability. So is their ad revenue growing consistently across the boards? And is it increasing all the way across, like Facebook, Google, a little bit of a pullback, but Facebook, Snapchat, things like that. Because as that grows, then you obviously want to start moving your marketing campaigns to there. You should be breaking up your marketing campaigns again. If it's like 100% bucket, you're looking at that, you should be percentages. So right now, I believe most ad budgets from a digital perspective should be 40% Google/YouTube, 40% Facebook/Instagram, and then there's another 20% in which you can kind of move around. I say 80% because that is where the largest dollars are going right now for ad, and not only is that where the money's going, but the money's consistently staying there and is growing. So you do the 80% there, and if you have the right creative and the right message, you're doing good. But then there's the other 20%, which is where you can make a lot of money. So why don't we kind of touch into LinkedIn? I'm looking at this right now, and I'd be very interested to find out. I would have to dig really, really deep into LinkedIn's numbers. Because without me digging too deep into LinkedIn's numbers, what I'm initially saying is if I'm an advertiser, okay, well, great. Well, LinkedIn by themselves, revenue jumped a solid 27%. I don't think that revenue has anything to do with ad dollars. I think it has some to do to ad dollars, but LinkedIn has this really bad stigmatism anymore, which you mentioned during the meeting today, of becoming a place where people go look for jobs. And if you go look at all the recent trends about the job market right now is completely tilted towards the interviewer or the interviewee, not the company that's hiring. So it's a bad spot right now for companies in the marketplace because there's just not a lot of people out there to fill these jobs. Now that's going to turn, but what's happening is you have a lot of companies who are vying for talent, who may not necessarily be going with a headhunter, and the ad dollars are going to LinkedIn right now. So I think you're seeing a spillover effect from what's going on in the job marketplace opposed to what's happening from right now from an ad perspective. Years ago, I loved LinkedIn. I thought LinkedIn was a great tool for B2B. It was really good, their native advertising. As of late, I feel as if LinkedIn really needs to get a much better grip on what they're doing because they are literally pushing the job thing big time right now. I find myself going less and less to LinkedIn for business news, and I find myself more and more gravitated towards Twitter, which is clean, easy, quick. I like it. I can go in and off. So people ask me routinely, what do you think about LinkedIn marketing? I think right now, if I had my ad dollars, I would probably in the neighborhood of about 5% to the in-mail product opposed to doing display or video for them right now. They actually have a text ads on the right-hand side. But even the in-mail is getting a little dicey now too because it's just kind of becoming bad where I see an in-mail come through and I literally just go right through it because I know they're trying to sell SEO leads or whatever. Yeah. So if you had to do LinkedIn right now, that's where I would do, but we are recommending our clients right now that LinkedIn is just not a viable option. Organically continue to post, but as I look at these numbers, I think these numbers are, unless somebody has data out there that says, hey, no, Len, this is all advertising, and great that I'm wrong, I still wouldn't put money there. But I'm going to believe that this has a direct impact on the job marketplace.
I mean, I think that's fair. I think you brought up a really good point of LinkedIn with such a heavy job focus, and I feel like a lot of the newer additions they've been adding, such as the live video feature that we've talked about in a podcast before. We talked a couple weeks ago about different reaction images, well, not images, but reaction, just like in Facebook, how you can react to posts. LinkedIn now has those. I think they're trying to shift it away from that, but I also think that that is an incredible challenge when you basically have everybody thinking, oh, this is the place to look for jobs.
It's Pandora's box.
Yeah.
You know, it's funny because we were even making a comment. They were talking about who, and obviously I don't want anybody leaving Comexis, but people grow in their careers and they want to do things. You know, at the end of the day, you need to optimize your LinkedIn profile before you put your resume together. I'm going in and looking at your LinkedIn profile as your resume. And that is truly where it's become. And I don't know how they're ever going to get back from that. And it's almost to the point where, you know, you have to wonder if they're ever going to be able to return to the spot of B2B news and things like that. And, you know, looking at company pages and so forth. It's concerning. But if I'm a shareholder of Microsoft, I like what they're doing because the way the market, this is great, but
Money's coming in.
Money's coming in, they're doing good. But from an advertising perspective, I'm definitely a little cautious on LinkedIn right now. A little bit of money towards in-mail. I am not recommending doing much more than that as it stands right now on LinkedIn.
Yeah, that's fair. Josh, any thoughts before we move on to Spotify?
Not really. I mean, when I think about it, I'm usually like right now it's like graduation season for a lot of schools. So when I'm on LinkedIn, I'm really just looking to see like, oh, like where's everyone going for their next job? Who got accepted where? Who's working this places? Who's moving around? So it's all the same. It's still, to me, it's more for a job network, but they're growing. So maybe that will change. But right now it's still how, you know, the way we say it is now still.
I think that's fair. So on to Spotify. So here are some quick numbers for Spotify. Spotify grew its paid subscriber rolls by 32% in the first quarter of 2019. They reached 100 million premium customers because of this. And in part, I think a lot of that had to do with they had some really nice bundles that they were doing with Hulu to make it so you get Spotify and Hulu pretty quick, which was nice. The company reported total quarter one revenue of $1.69 billion, topping analysts' expectations of $1.64 billion. They posted a net loss of $158 million versus a net loss of $189 million in the year earlier period. And ad-supported revenue grew 24% in quarter one to $141 million, which was just short of their expectations. Also in the report, which I don't have a bulleted point out here in my notes, they also had some great subscriber growth in international waters. So for example, in India, they had some really nice growth there. It was pointed out, however, that Spotify's paid subscriber base of 100 million is roughly double Apple Music, which only has about 50 million paid subs at the beginning of April, but Apple Music is growing faster, so they are tallying 28 million US subscribers versus Spotify's 26 million in the States. So what do we think about that?
Spotify, I mean, I know as we've talked about before, we're starting to roll out a couple campaigns on Spotify now, so we're fairly new to the game. I really would recommend Spotify / Pandora, which is now tied in SiriusXM, over regular radio right now. I believe that the digital radio is something where your money should be. It's a really good time to get in there for a really, the prices are not too expensive. This stock is too new. This company is too new to really dive too deep into the numbers. But from an awareness stage campaign, which is exactly where Spotify lives, this is pretty much only an awareness play, much like it is on radio. To me, this is showing where you have to start moving some of your ad dollars in here. And let's call it the way it is. It's a great spot where people are listening to music. The competition's not heavily there. And you can get in there now, make some money with it, and see if that you can parlay that money into more money and kind of build out your ad campaign. The only, I think, concern that everybody has with Spotify is, okay, well, what about the new, it says right here they're growing its paid subscription up, what is it, by 32%?
I believe that was the number.
It's only like $10 a month.
on another page.
All right, so
Yes, it was up 32 in Q1 2019.
So Spotify, you're going to make much more money on ad dollars than you are on a $10 subscription. Although $10 subscription is not bad, that's one people are least likely to cancel. So my question is, as an advertiser, is somebody who's a paid Spotify person, somebody who's really engaged with Spotify, they're there. If you're doing the free version of Spotify, you might be engaged, but you're not overly engaged. Well, I know I'm paid Spotify. I'm on Spotify all the time. So you generally have to ask yourself a question, well, if I'm going to start running ad dollars on here, how engaged is the audience, if with the free version? And I guess the question I have to say, and I will say, is Spotify, I think they're going to eventually do away with the paid version, and I think it's going to be commercials. So what you saw on radio and what you listen to now, if you're listening like our local station, 97.5 or 93.3, it's not going to be too far off from where Spotify is going to be in a couple of years. I just don't know how that's all going to go there. But in looking at the numbers, obviously it does well, but I think this is something where the earnings in this company is so fairly new that it's really hard to dive that deep into the numbers. But again, a recommendation for us, absolutely get dollars into Spotify. So,
I wonder if they'll do what Hulu does, or at least what Hulu did. They may have changed recently, where they had the free tier, which I think actually doesn't exist anymore. But they do here's like a $5 tier, you will get ads. And then here is X tier, you don't have ads, et cetera, et cetera. I could see them doing something like that, because there's a lot of functionality that Spotify gives you, like being able to download playlists to your phone, so you don't have to use Wi-Fi while you're out and about. That somebody might want to pay $3-4 a month for, while still getting ads for that experience. But I don't know. We see that ad-supported revenue is growing 24%, which is good. And you mentioned Spotify being pretty cheap. Everything I've seen is like, $250 minimum or something like that. And then if you don't have a voice actor, they'll have people doing it for you, which is super that's actually really nice, because sometimes the voice actor can be one of the most expensive parts of trying to run one of these ads.
And that's where you're looking at when people keep saying, well, how are they losing $156 million? And even though that's better than $189 million, you got to factor in the ad platform. They're trying to grow the ad platform. They're trying to have a sustainability to it. So you throw those kinds of things, which is, we know, voiceover, that's not cheap for a radio ad. You're talking a few $1,000 to have the right actor, right actress come in and record it the way you want to record it. So their self-serving platform is really good. I know they were disappointed by ad revenue only growing 24%, but that's still strong. So at this stage of the game, we would, kind of just dip your foot in the water a little bit with Spotify. But if we're having these conversations 3, 4, 5 quarters out, and Spotify is consistently at increasing 24%, increasing 30%, and we're seeing that, this is something that obviously you want to put more ad dollars in. Until they hit a plateau, I don't see Spotify's ad dollars, because people know this is kind of like a little hidden gem. I don't see their ad dollars actually pulling back. I think it's going to consistently grow. Yeah, Spotify.
Thank you, everybody, for tuning in to today's episode of The Buyer's Journey. Check us out on Comexis.com, YouTube, and anywhere you can get your podcasts. And please follow us on Twitter at @buyers_journey. Thanks for listening.